Assalamu alaikum. So today the inflation numbers came out. They were higher than expected. Inflation is still above 8%. And in response, the S&P 500 posted its worst week since January of this year. And that's saying a lot since this entire year has been pretty bad for the S&P. Now, I was not going to make a video. However, I did see some pretty bad advice, what I think is some pretty bad advice being given out on CNBC. So I'm going to show you the video and I want to respond to some of the points that were made in it because I think they completely missed the mark in terms of what investors should be hearing at this time. This is the video that I'm talking about, so let's listen in and I'll give you my commentary on what is being said.
You're not a professional trader, not sitting in front of a screen all day, and not with the ability to be nimble. Stop playing this game.
So basically, this person is saying that if you're not a trader, if you're not getting in and out of trades, because the market is downward trending, has a downward bias, you shouldn't be buying stocks. My advice is the opposite. My advice is that you should not be in this every day, getting in and out of positions frequently. This is the opposite of what people should be hearing at this point. And I'll tell you why I think this is in a second.
Are going to chop yourself up every time somebody tells you such and such is going to have solid earnings. It's not going to help. Here's what you can do and be very practical. First things first, tighten up the time frame on the trades that you're making. Second,
horrible advice. You should never try to time the market and be in and out of trades. This is a fool's errand. If you have very short time horizons, you shouldn't be in the market at all. The only tried and true method with regards to making some money in the stock market, building wealth, is to have a long-term investment horizon. If you have a short-term investment horizon, you shouldn't be in the stock market not now or ever. That's what should be said on this channel, not the opposite.
Don't go into anything without a predetermined stop loss. I talked about a short...
I can't even begin to describe to you how nonsensical I think this is. A stop loss basically says that if the price of X stock goes down to this level, then sell it for me. Which makes no sense because if you think that stock ABC was fairly valued at price X, then at price X minus Y, you should think it's even more of a bargain. If you like the stock at X, you should like it even more at X minus Y. That just makes sense to me. In fact, the whole point of active investing, the whole point of picking stocks and not just passively investing in the market, is that you believe that there are some mispricings in the market that happen every now and then, and that you're able to identify these mispricings, buy a company for less than what it should be priced at. And that difference between where the company is and where it should be priced at is your alpha, is the return that you earn that is above and beyond the return of the market. So losing faith in a stock because its price has fallen is, I would say, the mark of a less successful investor. The better investors, think Warren Buffett or Peter Lynch, understand what they've bought and understand why they bought it at the price that they bought it. And therefore, when the price goes down further than what they bought it for, if their thesis for the company has not changed, they buy more of it because it's even more attractively priced. It makes no sense for someone to say, I want to buy this pair of jeans for $40, but if it drops to $30, I'm no longer interested in it. That makes no sense. And it's a surefire way to not do well in the stock market.
In FedEx, I know exactly where the market tells me I'm wrong.
That's the point. The market in the short term does not know right from wrong. In the short term, the market is a voting machine. Only in the long term does the market tell you if you're right or wrong. In the long term, the stock market is a weighing machine. In the short term, it's not. In the short term, the market is dictated by investor sentiment, how greedy or how fearful they are, not the fundamentals of a particular company. So the market doesn't say if you're right or wrong in the short term. The market just tells you how investors are feeling about a company in the short term, not whether or not you were right or wrong to buy it based on its fundamentals.
And that's where I'll be out of that. That is the way that you have to comport yourself in this market. If you're a longer term investor, this is not an environment for you to be picking through and trying to understand whether or not Wall Street's estimates are a penny high or a penny low for next quarter. None of that kind of behavior is going to help in this environment.
Listen to what this person just said. 8Ks, by the way, for those who are unfamiliar, are where companies report major events. Basically, this person, Josh Brown, is saying that this market is not valuing fundamentals. It's not looking at fundamentals. Therefore, there is a decoupling between the price of stocks and the fundamentals for those stocks in this market. So what should that mean for a rational investor? It should mean there's great opportunity in this market, because the fundamentals are not being fairly represented by the price. That's where you make money. You make money when you buy something for cheaper than what it's actually worth. And in order for you to figure out if a company is actually cheaper than what it's actually worth, you have to look at things like 8Ks and 10Qs and 10Ks, major events, quarterly reports, and annual reports. That's how you figure these things out. This is exactly the time to look at 8Ks and other reportings because the market is acting irrationally. This advice is totally off.
So I think long-term investors need to remind themselves there are periods of time where the market does not reward fundamentals and does what it's going to do. And if they're not going to be in here every day, they shouldn't be in here at all.
This is exactly what I'm saying. There are periods of time where the market does not reward fundamentals. That means that the market is mispricing companies. That means this is the time to understand the fundamentals of companies so you can understand which ones are mispriced, buy them, and over time, the market is going to correct its mispricing and the price will follow the fundamentals. And that's where you make your alpha. That's where you make your above market returns.
Be diversified. Yeah.
What does that mean? He just said don't look at companies' fundamentals because the market is not rewarding fundamentals. Now he's saying be diversified. So what are you saying, Josh Brown? You're saying just spread your money randomly without understanding what you're buying? And that's a better strategy than picking out the companies that are mispriced based on their fundamentals? That's the better strategy for long-term investors? How is this true? How does this make sense? And what kind of irritates me about this is that I know that if the inflation numbers were on the lower side, lower than expectations, and the market was actually rallying today, the message would be exactly the opposite. And I know this because look at an earlier video of this same analyst. This is from October of 2021. His mood is much better because the market was going up. So listen to what he has to say here.
The consumer's balance sheet in history has never been in as good a shape as it is right now. That is actually...
This is, by the way, as I mentioned, this is October 19th, 2021.
Best part of the economy today. Then you look at the high beta names. The ARK names are running. All the high beta stuff from last year that spent this whole year getting murdered, starting to look like they've bottomed. Zoom is a really great example of that.
Okay, so he's saying that it looks like Zoom has bottomed. Let's look at where the price of Zoom was October 19th, 2021, some 9 months ago.
Shopify, Spotify, both ripping, even Teledoc, which...
So you see here on the screen, Zoom is $278. This is where this particular analyst is saying that it's bottoming out. Okay, what's the price of Zoom today? $109. This is what happens when you look at charts and you make decisions, buy and sell decisions based on charts and not fundamentals.
I've ever seen. That looks like it bottomed. And then you look at the big winners. Snow, oh my God.
Okay, he said Teledoc looks like it bottomed. Let's look at Teledoc today. Teledoc, when he was saying this, $138. Today, it's $31. Again, don't make investing decisions based on charts. Maybe if more attention was being paid to 8Ks and 10Qs, we would have known that it wasn't bottoming out and it had more room to fall. And I don't mean to pick on any particular person or analyst. Everyone gets it wrong sometimes. I certainly do. But the overall theme of the message that was coming from this analyst today, I think, is the exact opposite of what needs to be said. This is the time to understand what you're investing in. This is the time to really dig into the fundamentals and to figure out which companies are being mispriced based on their fundamentals. And this is the time, if you have a long-term investment horizon, where wealth in the stock market is built. It's built when market sentiment is bearish. And it hasn't been this bearish in at least 3 years. This is where the opportunity lies. So I hope you found this video beneficial. If you did, I'd really appreciate if you left a like and subscribe. If you want to follow my investing, what I buy, what I sell, when I do that, and be privy to investment insights that come from the perspectives of people who are trying to build wealth in a halal way, then consider becoming a PIF member. Link to do so is in the description of this video. Until next time, make sure to take care of yourself. Assalamu alaikum and peace be upon you all.